Hi, guys, and welcome to the 32nd episode of the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we start with a chart of the S&P 500, the market. And this week was an explosive week. As you can see, the red arrow here denotes Monday, Tuesday, then Wednesday, Thursday, and Friday. Basically, this is just a rip in your face market. It went from as low as 591 and we finished at new highs. These are official new highs for the S&P 500. Pop the champagne. So obviously it has to do with the fact that the war in the Middle East is going to be over. Trump declared victory. Iran's nuclear weapon facilities are done. So that's what happened here, and it just on between Monday and Tuesday, and since then the market has been going up in a straight line. Okay, so call it what you want, FOMO or whatever, but that's the story that's going on, and the fact that we closed at new highs is a very positive thing for the end of the week. We also have end of month coming, so generally speaking, the market is probably going to be bid on Monday, which is the last day of the month, and most probably up until the 4th of July, after which a lot of the big wigs at the big firms, trading firms, brokerages, whatever, the Morgan Stanleys, the Goldman Sachs, they take vacations, and that's where we get into 2 months now, up till September, which is here, 2 months of the summer doldrums. During the summer, usually, you can't say usually because it's basically flat. Sometimes the summer months are melt ups or like slow grinds up, not melt ups, but slow grinds up. And sometimes they're slow grinds down. So we don't really have a signal, but we have very thin type trading in the summertime. Okay. So before going on, let's talk about what we always talk about first. It's the technical picture of the S&P 500. Okay. Let's bring in the moving averages. Above the 200, upward sloping. The 50 is going to make that, the 50 moving average is the red, the 200 is the blue, and it's going to make a golden cross soon as the market goes at highs. So, and even the short-term moving averages here, everything is trading above the moving averages. Very positive market momentum. The picture is nothing but bullish. Okay. So that is the technical picture. It's clear as day. You should be net long, net bullish. However, starting around here, I started taking some short positions that will expire in July and August. Not a lot, about 2% of my portfolio, but it's just protection because now we're getting into like rarefied air. Okay, and what else can we do at this point that could support this bullish outlook, this bullish technical picture? Well, as always, we'll look at the sentiment. The fear and greed index is at 65, smack down in the middle of greed. It's not an extreme greed. We can go higher. However, if you look at the components, some of them are still off. Like the market momentum is neutral. It's not. It should be a greed or extreme greed. And it might be affecting this overall fear and greed index gauge. So maybe we are already at extreme greed. We don't know. Another thing we should look at is the put call ratio, and put call options are very low. Okay, it's greed. It should be even higher, I think. So if you look at all these factors, sentiment is still pretty high when it comes to fear and greed. However, but if you take this at face value, there's still more room to go. And the other thing that we look at is the AAII investor sentiment, and that again still pretty bearish. Okay, 40% bearish, only 35% bullish. That's like even lower than the in terms of bullishness, even lower than the historical averages. So this is basically neutral. Fear and greed index is greedy, let's say, but not extreme greed. So there's still some fuel in terms of sentiment to push this market even higher. Okay, so my outlook has been neutral. I'm still net long, although I have some short exposure, 2% of my portfolio, because we're heading into the summer months, which are basically thin and non-eventful. Generally, doesn't have to be the case. We can slowly grind higher. We've seen that before. But I've added 2% exposure about short exposure via puts and certain other vehicles and individual stocks. Because the rationale is that we're starting to get a lot of bullishness. And if these markets do correct, I don't expect to correct a lot. Maybe they touch the 200, maybe not. There are some gaps to fill. This one, the Trump gap right here after winning the war, is one of them. So we can go down to 600 easily and still be bullish. We could touch the 200, still be bullish. And this gap has not yet been filled. So we could, down here, I don't really see it going all the way down to 565, 560, barring something crazy. Because that would be like, 5% correction, 5-6% correction. That's a lot, okay? But the rationale behind the put exposure is that if you have 2% of your portfolio in puts, okay, and the market drops 5%, okay, let's say you're holding a portfolio that is has a beta of 1, that means it goes with the market. The magnitude of the moves are similar to the market moves, okay, so that you're just basically holding the market. Okay, if the market goes down 5%, you will lose 5% on your general market stocks, but your puts that make up 2% of your portfolio might go up 3, 4, 5x. So, 2% times 3, 4, 5, it's another, 6 to 6. Like if it goes up 3%, you have 6% increase in your portfolio. And if it goes up 5, you'll have a 10% increase in your portfolio. So if the market goes down 5% and you're holding those puts, just 2% exposure, that will make you profitable. You'll be down 5% and then maybe up 6% to 10% on your puts. I mean, down 5% on your general stocks and then up 6 to 10% on your puts, which means you're ahead 1 to 5% overall. And if the market goes up 5% or whatever, you will lose 2% on your puts, but you'll gain 3% on the market. So you're basically, no matter what happens, you're good. Okay, unless it just stays flat for the whole 2 months and does nothing without moving, which is rare. So in the summertime, you want to be able to, have a, not a stressful time. You want to be able to relax and not care whether the market will drop 3, 4, 5%. Okay, and that's what the puts do. So that is the overall look when it comes to the technical picture. So let's move into the macro. Okay, there were a number of macro events this week. The first is GDP came in. U.S. GDP growth rate was at minus 0.5%. I think they were expecting minus 0.2 or 0.3%, so it was worse than expected. So I guess that the market shrugged. I mean, the market doesn't care because it kept going higher. As you can see, the whole week, much higher. So the GDP growth rate came in, didn't really affect the market much, even though people started spending less, which is bad for the market. The market thought that bad news is good news because then the Fed will probably cut rates going forward, and we'll get to that sooner. The next thing we look at is initial jobless claims. They came in at 236K, okay, which is still okay. It's not exploding higher. It's actually going lower. So that's exactly what you want to see. Nothing to be alarmed yet, okay? And the big thing that came out on Friday is the PCE, core PCE, was at 0.2, but they were expecting 0.1. Okay, the headline number came in at 0.1. The headline PCE is 0.1. They're expecting 0.1%. So nothing really, slightly hotter, but still pretty low inflation. Okay, so I guess given all of these three things that we saw today, saw this week, the GDP growth rate, the initial claims, and the inflation figure, all of that has an effect on what you really want to be looking at is interest rates. Okay, so let's go over to the Fedwatch tool to see what are the expectations for Fed rate cuts going forward. This is the Fedwatch tool. We're looking at July 30th, and there's an 81% chance of nothing, no cut, and a small 18% chance of a cut coming up in July. This is big because before it was like nothing. It was like 3-4%, and this was like 95. Okay, so basically, and wait, let's see what the market thinks will happen in all of 2025. Okay, this is no cut right here, 4.25, and now we're going to 3.5. So 3 cuts. Remember last time we looked at it, this was at 40%. 2 cuts were at 40%, and this was like 30. So now the market is switching to 3 rate cuts instead of 2 for the year in the most likely scenario. 47% chance that 3 cuts happen. So basically, the cuts are not going to happen in July, but they expect it in September, 1 cut, and in October, 2 cuts. Okay, so in all of 2025, they're expecting 3 cuts to come in, and that's why I think the market is going up. And the reason for that is, I guess, falling inflation, falling rates. Okay, so that is the catalyst that we said before in our bullish scenario. We expect the catalyst for the market grinding higher would be lower inflation, which means lower Fed rates, which means higher chances that the Fed will cut more in 2025, which is what happened. So now because the Fed, instead of 2 cuts, we're going to 3 cuts for 2025, this market's going up. Okay, slowly going up into the summer months. So that's what the macro is telling us. The macro is telling us that basically everything is geared towards higher chances of rate cuts for the Fed going forward. But is that the case? I don't know. We'll have to see. I don't think the Fed cuts 3 times this year, especially if the market is, and the economy stays strong. Maybe once, and towards the end. That's my expectation. But I don't think I see anything where the Fed will budge at any time soon, especially since they think that tariffs will be inflationary going forward, even a little bit. And we haven't yet seen the full effects of tariffs kick in, especially since negotiations are still happening between Trump, the EU, and China. China's the big one. So that's it for the macro picture. In recap, we think the big move, the big takeaway from this segment is that the chances of Fed rate cuts have increased from 2 to 3. The amount of Fed rate cuts have increased from 2 to 3 in 2025. So let's go on to some of the things I was discussing on my Twitter. Let's recap the metals, okay? Because as the market's going up and you have risk off, the metals usually suffer because they are risk off beneficiaries, and when you have risk on, the metals usually suffer. So let's go, and commodities in general. So let's go to gold, the first one, my favorite. And yes, as you can see, for the whole week, gold has been going down. However, especially on Friday, it went down big, but before that, it was holding up fairly well, holding the 50. Now it broke the 50. Okay, this is the first time that's actually closed below the 50 in a long time. That just means the trend might be broken, and we consolidate for a little while. However, my outlook still stays the same. I still like it. I think as the market goes up, gold will still catch a bid because the fundamental reasons for gold going up are still there. Foreign central bank buying primarily China. So all I was hoping for gold for the whole summer was to stay flat and above this 3,000 level, and it's doing that. Could it tank? Yes, we don't know with the future, but as long as it stays above 3,000, you will see allocation into the space, especially the junior space. So yes, on Friday it was down. Will that continue? Let's see. Okay. I personally don't think so. I personally think gold hovers around these highs for the whole summer in October, and then maybe it rips October, November, December. Okay, the new cycle up. But that doesn't mean that the miners are going to go down. Miners could actually catch bids because they're way behind in terms of their valuation vis-a-vis the high price of gold right now. Okay, so I'm still okay with gold. The next thing that we look at is silver. Okay, silver. Remember what we said. The breakout in silver has to be real. And how do we define real? That if it breaks out, it stays above these levels, above the 35 level, for 1 to 3 weeks. And so far it has. It's consolidating the highs, and that makes the RSI go down, which is this bar right here, into neutral territory, which could fuel the next rally higher. Okay, so I still like silver a lot, even though today Friday, like, it's pretty much flat for the whole week, down and then consolidating. So I'm still positive silver and some silver stocks. Okay, but silver in general, I think, is behaving very, very well. So our second best metal is doing very, very well. And the last but not least that, nobody really talks about anymore is like copper. Copper is breaking out of these levels. It has to get past these highs, but this old level was retested after the breakout, retested, and now for the whole week, look, this is the week. We can mark, let's get rid of these moving averages. We don't need them anymore. It's just cluttering things. Which is Monday. This candle right here. The green one. So on Monday, and the whole week, copper ripping from $4.77 to $5.12. That's big. Above $5 is huge for copper. Okay, so pay attention to this. This is really surprising to see with markets going up. So you have gold here. So let's recap what happens with what's going on with the metals. We have gold here taking a hit on Friday by still staying relatively high in the face of a risk on bullish SPY picture, which closed at new highs. Okay, gold should have been slammed, still holding. It could in the future, but so far this is a positive sign. Silver too should have been slammed, holding at high levels. And copper, why is copper up? Should have been slammed too. Okay, so you're having these anomalies that are happening. Okay, that bodes well for the metal space, despite the fact that we're at a time where it shouldn't be happening, the summer. Okay, so that's all I wanted to talk about the metals and recapping their anomalous nature at this point in the cycle. And now let's try a new segment. I want to talk about something called quick takes. I'm going to start doing this when I do my weekly wrap up. I'm going to just talk about some quick things that I've seen happening in this market, different stocks and ETFs. First, we should mention QQQs, new highs and ripping. Okay, these guys are leading the market. In a healthy bull market, you should see tech and specifically SMH, the semiconductors, rip. And they are. The semiconductors are at highs and they're performing very well. So this bodes well for the market going forward. They could correct, yes, but so far what you want to see in a bull market, you're getting. Okay, you're not seeing this sector lag. Okay, so you're seeing tech and NVIDIA, all these big guys at highs. Okay, you're seeing Microsoft ripping high after crushing earnings. Okay, so you're having all the big tech guys follow. So you're having the same paradigm going on that has been going on for 10 plus years, since 2009, tech leading bigly and big tech leading everybody. Okay, so you have that as support. What I noticed is, another thing that I noticed is Palantir up. But something very strange happened in the last seconds. Okay, you saw it just crash big time. I don't know why. I'm trying to figure it out. I'm looking at Twitter. Okay, let's see Twitter here. Let's see Palantir. Has anything new come out? Nope. Some funny memes. Palantir into the close. Tanking. No. Nobody seems to know. Oh, this guy might have it. Maybe it's the Russell 1000 index changes. This rebalancing reflects shift in the underlying capital markets. It's possible. But that maybe could happen towards the end when somebody just dumps it. A big fund comes in and dumps millions of shares in the end. It's possible. But Palantir dump, and look, if you look at the 15-minute chart on Palantir, you can see it was literally in the last 15 minutes. But, post market, it's back up to 134. They tanked it from 138 to 130, but now it's made up half the gain. So it's probably some market-related thing. Somebody had to dump at the close. Strange to see that. That's all I wanted to see. On this is it coming back post-market. Let's see what happens at the close on tomorrow. I'm saying tomorrow, but I mean on Monday with a monthly close. Will it do the same thing? Will there be another big dump? Because people might be dumping their positions before the summer, before quarter end, before the half year. The first half is over. So we have to see if that's the case on Monday as well. Okay, so just mental note on Palantir. And the other thing that I like to talk about, one of the positions that I'm still looking at is Baba. Okay, this is a time where it's starting to consolidate. I'm thinking of going long here. Okay, I'm thinking of going long at these parts. Not quite yet. I'll look it over more closely over the weekend, see what's going on. Maybe it'll consolidate a little bit more before going, but it might be worth going long soon on Baba, which is what I look for in the Chinese market. I'm starting to like the Chinese market again, as you know, and I've been patient after this big rip, waiting to get into Baba. This big drop was way too fast. The premiums were way too elevated to get in calls. So right now they're probably much better. So I'm really thinking of re-entering the Baba trade long again, okay, after taking profits here on my initial position that got long here. I took profits around the 110 level, ripped in my face, could have made more, who cares, you make your money, you leave, and then you wait till you come back. So this might be the time to come back into Baba. And another thing I noticed is GE Vernova. This thing is ripping. Okay, they're into windmills, they're into nuclear power, they're into just basically renewable energy as well, storage. I just think it's getting overextended, and I was waiting to short it, okay? But I needed a technical reason to do so, and I got it this Friday. Today, you see like it's going up to new highs, and yet you see negative divergence on the chart. So I took in a short, a calendar spread that expires in September. The 480, 400 put spread, I bought it, and for September. Okay, I just think this is due for a correction, and I was just waiting for the right time to do it. I needed the technicals to back me up, so I'm doing it. So after I had this negative divergence on the RSI, I'm going in, because I was looking to. So I added another extra short on top of my other market shorts that I have. So that's it for this week. So let's reiterate: bullish close. I still have a neutral outlook. Okay, net long but neutral, not super heavy either way. And I will probably switch bullish if I see the same thing going on with the market as I saw with silver. That is, after a breakout, I want to see it hold these levels for 1 to 3 weeks before deciding to probably, it'll probably be a bullish summer if that's the case. So instead of maybe just a ho-hum type of summer or a negative one. So overall, technical picture is bullish. The fundamentals still haven't broken down. We're still good. Inflation's in check. And everything's looking great. Let's see what happens after the 4th of July and next week. All right. Later, guys.